of the day, it has to be the strong GDP numbers that Rima was just referring to. 8.2% kind of a growth in the second quarter. That takes the first year's average now to 8%, making sure that for the full year, we're probably set to cross about 7% or so of the rates, and how that makes RBI's job difficult. That and a whole lot to address. So we'll bring in our guests. Aditi Nayar, the chief economist at ICRA, is joining in. Also with her, we have another economist. We have Madan Sabnavis, chief economist at Bank of Baroda, with us. Aditi, Madan, both of you, thank you so much for your time. Aditi, first, this differential between the nominal and the real GDP, thanks to that 0.5% deflator that people have been talking a lot about over the weekend, it's come down, I think, from a wide difference from 2023 to now where it is currently. What was some of your additional reading on this? I mean, is that still somewhat of a negative, the fact that nominal GDP is still at 8.7%?
Thank you so much. Well, the fact is that with inflation levels being so low, both for the CPI and for the WPI, there was no option but for the deflator to be as narrow as this. And I think this trend is going to continue in the current quarter as well. In fact, the deflator may be even lower in the current quarter than what it was in Q2. After that, as the inflation prints normalize, particularly for the CPI, we should go back to relatively normal looking deflators in Q4 and in Q1. So because of the deflator being low, as the real GDP growth number, we're expecting it to show some amount of base effect-led moderation in the second half of the year from the 8% real GDP growth that we've seen in the first half of the year. So, we will possibly be looking at real GDP growth coming off in Q3, nominal GDP growth being very, just slightly higher than that. And then in Q4, at least, the deflator being a bit higher, which would take the nominal GDP growth up in Q4 as compared to Q3.
Aditi, what is your sense for FY26 for the full year? We've already crossed 8% now with the first half. What would that number look like?
So we're looking at 7.4% now. Definitely, we got a very high and an unexpectedly high growth in Q2 and also in Q1, which was on a lower base. But if we look at the kind of quarterly trends that we had in FY25, we saw the real GDP growth going up very sharply in Q3 and in Q4. So that is possibly something that's going to be a negative. A couple of other headwinds that we're looking at, we really don't know how finally the export situation will pan out, given the tariffs related to the US, both for goods and for services. Is there going to be more pain ahead? In any case, a lot of upfronting has happened for exports. So, possibly whatever good news there was is in the past, and the second half of the year may not look very good in terms of exports to the US. And also specifically when we look at the government fiscal data, for the government of India, the headroom which is left now for capital expenditure as compared to its budget for this year implies a 15% contraction in the second half of the year. We're hoping that there will be some sort of reallocation or an increase in allocation towards capex in the second half of the year so that this doesn't really turn into a headwind. But these are the things that we'll be watching out for. As of now, our full year real GDP growth forecast is now 7.4% after the higher than expected growth that we got for Q2.
Okay, just want to get both your opinion on what we should expect from the RBI this Friday. Does this Q2 GDP stunner push forward expectations of a rate cut, alter that? Aditi, you go first and then Madan come in.
So we thought that before getting the real, the GDP data on Friday, we thought that the balance was slightly tilted towards a final cut. But I think now after looking at an 8% average growth for H1, possibly we're in for a pause on Friday.
Okay, Madan?
In fact, we believe that the rate cut cycle is over even before the GDP growth numbers came in. The reason is that whenever you're talking of a rate cut, the question to ask is what exactly are we trying to achieve? Are we trying to bring about growth? I think that definitely is not the case because we're talking of India's GDP growth rate being in the region of close to 7.5% per year. Inflation, we all know, is something which has been down primarily on account of the base effect as well as food prices coming down. Now, this is something which will get reversed as we go towards the end of the year. And by the time we go into the next financial year, we are actually talking of inflation in the region of around 4 to 4.5%. So going on the basis of the real repo rate, which I think is going to be the final kind of a target, it may not be overtly stated, but that is something which is going to play around. I think 1.5% is the kind of real repo rate which we're looking at. And at 5.5%, I think we seem to be well priced. So therefore, end of the cycle, we remain at 5.5% for the year.
But Madan, call it me being the devil's advocate here or greedy for more. For the acceleration, we heard a lot of experts saying that for an acceleration to push towards the $5 trillion economy target, you need to grow at 9.5%, 10% on a sustainable basis. But if you would believe that an 8% growth would halt the rate cutting cycle, would another 25 not accelerate that push? Or do you believe that there are enough headwinds in place for the second half for the RBI to stay on cautious mode right now and then use that gunpowder when the need arises genuinely?
See, there are two things here. One is that we should remember that companies do not borrow money merely because it's cheap. So we saw during the pandemic where the repo rate was 4%, companies did not borrow just because money was coming cheap. So the important thing is to look at how demand is evolving. So as of today, there are signs that demand has taken off, especially in the consumer goods space. And there is reason to believe that capacity utilization rates could be improving here. And therefore, there could be some incentive to invest. And even in the past, we have seen that interest rates have really been the limiting factor for investment. When you see buoyant demand, you will tend to invest and possibly pass on the higher cost of interest costs to the consumer. But when we are talking of excess capacity, demand just about picking up, that's what we're expecting in Q3 on account of the GST 2.0 reforms. I think there is still a lot of space for investment to take place, notwithstanding the fact that the repo rate could be at 5.5%. Because finally, at the end of the day, RBI will also have to balance what happens to savings, which I think was mentioned in the discussion of the minutes, which was released for the last policy.
Madan, quick word on what your number for FY26 is. We've seen a spate of upgrades after the Q2 numbers came in, median pointing to around 7.4, 7.5% kind of a number, whereas RBI is still at 6.8. What sort of a revision do you expect there, and what is your own number?
Yeah, our number is 7.4 to 7.6. This is the number which we had when the GDP for second quarter was out. I would tend to believe that RBI would also probably revise it in an upward direction. It would be in the 7% range. They normally tend to be a bit conservative, so I don't expect them to go to 7.5. It would probably be 7.2, 7.3%.
Okay, so not a steep up move there from RBI, but a 7.2, 7.3% kind of a upgrade. But Madan, quickly, your comments also as well on what I was asking Madhvi, essentially this 0.5% GDP deflator. Are you worried that would be exaggerating the real growth numbers that we're seeing? Because in the second half, without the base effect, without this, export up move, what sort of a number are we likely to see?
So actually, if you look at the way in which GDP is calculated, you get the value of commodities, which is always only at current prices. So when we're talking of real GDP, where we want to remove the price effect, that's when the deflator really comes in. So I don't see anything inappropriate or anything which is untoward when we're looking at 8.7 and 8.2%. I mean, that is what is bound to play out when we're talking in terms of reducing anything at current prices into real terms. And since our inflation numbers have tended to be negative for WPI, very low for CPI, it's but natural that this number comes down. Now, is it going to create a problem, except maybe an academic discussion as to we are used to maybe around 2.5 to 4% difference between the two growth rates. Now it's going to be very much narrow. I think the issues will actually come up when you're looking at other kind of ratios. You're looking at the fiscal deficit. You're looking at the current account deficit. Those are the numbers which would tend to be under pressure on account of the denominator not growing at a very high rate. But the difference between the two, I think, is something which is perfectly all right. I don't see anything wrong in the methodology or in the approach taken by the CSO when they are computing these numbers. It's but natural because we've had very unusual inflation numbers, which all of us know is more because of statistical reasons. Because if you go to the market today, I think none of us can really believe that vegetable prices have actually fallen. They've actually gone up. But the CPI is going to continue to show that vegetable inflation is in the negative region. So I think these are the kind of anomalies which are there, but I don't think there is anything to get worried about.
All right. We're done with the first half of the year with an 8% average. We'll see what the rest of the year looks like. Aditi, Madan, both of you, thanks very much for joining in here. I guess, Hormaz and Reema, the real question really is on Friday.
Yeah.
How can RBI justify that rate cut when the economy is firing at 8% kind of growth rates? I think it's going to make RBI's job real hard.
Real hard, no doubt about that. We will slip into a short break. On the other side, we'll discuss crypto markets with Manisha Gupta on the other side. Stay tuned.